Most investors chase quick wins, but the smartest ones follow timeless principles from a book written over 70 years ago. Why is this book considered the Bible of investing? And what powerful lessons from it are ignored by 99% of modern investors? In this audio summary, we will unpack the most important takeaways from Benjamin Graham's legendary book and how you can apply them to build long-term wealth in today's stock market. Ever felt overwhelmed by flashy stock tips, risky bets, or confusing financial advice? This book cuts through all that noise, and we will break it down for you. By the end of this audio summary, you'll walk away with rock-solid investing principles used by legends like Warren Buffett, and the clarity to start investing smarter, not faster. If you're new to this channel, don't forget to hit the subscribe button so you never miss an update. And be sure to leave a comment letting us know whether you're a trader or an investor in the stock market. Imagine you're sitting across from one of the most revered minds in investing history, Benjamin Graham. The father of value investing leans in and says, "The investor's chief problem, and even his worst enemy, is likely to be himself." That quote is more than just a memorable line. It's the foundation of a philosophy that has guided generations of successful investors, including Warren Buffett. Welcome to The Intelligent Investor, a timeless classic first published in 1949, yet still astonishingly relevant. It's not a book about how to get rich quick. It's about how to avoid being stupid. It's about building discipline, thinking long-term, and refusing to let emotions dictate financial decisions. Whether you're brand new to investing or already knee-deep in stock charts, this book offers a compass, not just a map, for navigating the markets. But let's face it, the original text is dense, and some of the references feel like they belong in a history museum. That's why we're here, to breathe life into these ideas and show how they apply in today's world. At its heart, Graham's philosophy revolves around two central characters: the defensive investor and the enterprising investor. You don't have to be a Wall Street analyst to succeed. In fact, Graham believed that most people are better off being defensive investors. Those who adopt a passive, patient approach, investing primarily in diversified index funds or high-grade bonds. It's the tortoise, not the hare, who wins this race. Let's consider Olivia. She's a school teacher in Atlanta. She doesn't have hours each day to analyze stocks, but she does want to grow her savings over the next few decades. Following Graham's advice, she sticks to low-cost index funds and focuses on saving consistently. She ignores the noise of financial news and lets compounding do the heavy lifting. That's intelligent investing. Contrast that with Leo, a tech-savvy 26-year-old in San Francisco. He's fascinated by market trends, digs into financial reports, and actively manages a small portfolio. Graham would classify Leo as an enterprising investor, someone who has the time, skill, and emotional resilience to analyze securities and take calculated risks. But even Leo must remember Graham's cardinal rules. Don't speculate. Insist on a margin of safety and treat stocks as businesses, not lottery tickets. Now, what's this margin of safety? It's one of the core principles in the book. Graham argues that no matter how confident you are in a stock's future, you should always buy it at a discount to its intrinsic value. Why? Because the future is uncertain. Margin of safety is your buffer. It protects you when the unexpected happens. Think of it like driving with a seatbelt. You don't expect to crash, but you wear it anyway. Intelligent investors don't assume their analysis is perfect. They leave room for error, and that humility often separates success from failure. Another iconic concept from the book is Mr. Market. Graham describes the stock market as a business partner named Mr. Market, who comes to your door every day offering to buy your shares or sell you his. Some days, he's euphoric and offers high prices. Other days, he's depressed and offers you a bargain. Your job? Don't let his mood swings influence your decisions. Take advantage of him, but never follow him. This metaphor is incredibly relevant in today's world of social media, 24-hour news, and meme stocks. When the crowd is excited, prices soar. When fear takes over, they plummet. But the intelligent investor stays calm, rational, and focused on long-term value. So, why does this book still matter? Because human nature hasn't changed. Fear and greed still drive markets. People still chase trends, ignore fundamentals, and panic during downturns. Graham's advice remains a lighthouse in the storm, a reminder that true investing isn't about predicting the future. It's about preparing for it. In the next chapter, we'll break down the specific traits of the defensive and enterprising investor. We'll explore their strategies, the types of securities they should consider, and how their paths, though different, can both lead to financial security. Whether you're an Olivia or a Leo, Graham's wisdom will guide you. Imagine you're about to run a marathon. Some people train for months, track every calorie, and hire a coach. Others jog on weekends and just hope to finish. Both can cross the finish line, but they require different strategies. In investing, Benjamin Graham offers two distinct training plans: the defensive investor and the enterprising investor. Let's start with the defensive investor. This approach is tailored for those who want to avoid risk and aren't interested in analyzing financial statements or market trends. It's a strategy built for simplicity, consistency, and peace of mind. The defensive investor seeks safety, steady returns, and minimal effort. According to Graham, this kind of investor should focus on a portfolio made up primarily of high-grade bonds and blue-chip stocks, or, in today's context, low-cost, diversified index funds. Think of the S&P 500, U.S. Treasury bonds, or a total market ETF. The goal is not to beat the market, but to match it, quietly and reliably. Take Karen, a busy nurse in Seattle. She sets up automatic monthly investments into a total market index fund through her retirement account. She rebalances her portfolio once a year and spends the rest of her time living her life. No stock picking, no obsessing over market headlines, just quiet, patient growth. Graham would applaud her. Then there's the enterprising investor, the one who wants to do more, take more responsibility, and ideally earn higher returns. But with greater potential comes greater risk. The enterprising investor studies markets, digs into companies' balance sheets, understands valuation models, and controls their emotions through market swings. Let's say Jason is a data analyst in Boston. He spends weekends reading 10K reports and industry analysis. He carefully selects undervalued stocks with strong fundamentals and solid management teams. He's not a speculator. He's a value hunter. Graham would support Jason's efforts, as long as he stays disciplined and keeps his expectations grounded. But here's the catch. Graham warns that most people think they're enterprising investors, but few truly are. It's easy to overestimate your skill and underestimate your emotions. If you chase trends, follow stock tips, or panic during downturns, you're not really being enterprising. You're speculating. The good news? Both paths can work. The key is choosing the one that matches your temperament, lifestyle, and goals. Don't try to be Jason if your schedule looks like Karen's. And if you're not passionate about finance, there's no shame in being defensive. In fact, many studies have shown that passive investing outperforms active strategies over the long haul. Graham also emphasizes the importance of consistency. Defensive or enterprising, the intelligent investor maintains discipline in both bull markets and bear markets. That means having a strategy, sticking to it, and not letting emotions hijack your plan. Ask yourself, are you prepared to see your investments drop 30% and do nothing, or even invest more? That's the kind of resilience the intelligent investor must have, because the markets will crash again. That's not a prediction, it's a certainty. The question is, will you be ready? In the next chapter, we'll dive deeper into the psychology of investing, why we fear losses more than we enjoy gains, how overconfidence sabotages returns, and what Graham says about the dangers of speculation. To become an intelligent investor, you must first master your mind. Picture this. The market drops 5% in a single day. Your phone lights up with alerts. Social media explodes with panic. Headlines scream, "Worst day for stocks since 2008. And your gut? It twists. You start to question everything. Should you sell before things get worse? Should you have seen this coming? This, right here, is where most investors lose. Not because the market went down, but because they let fear take over. Benjamin Graham understood this all too well. He knew that the most dangerous thing in investing isn't a bad market, it's bad behavior. And behavior is rooted in psychology. Let's start with loss aversion. Studies in behavioral finance show that the pain of losing money is psychologically twice as powerful as the pleasure of gaining it. That's why people often sell winning stocks too early and hold on to losing ones too long, because avoiding pain clouds judgment. Then there's overconfidence. Most investors, especially when markets are booming, start to believe they're smarter than they are. I beat the S&P this year, they say. I can do it again. But outperforming once doesn't guarantee future success. In fact, it might just mean you got lucky. Graham's solution? Humility, patience, a commitment to rules rather than gut feelings. The intelligent investor doesn't chase fads or follow crowds. Instead, they embrace a strategy and stick to it, even when it's unpopular. Let's go back to Mr. Market. Remember, he's your moody business partner. His emotions are wild. Some days, he'll offer to buy your stocks at ridiculous prices. Other days, he'll sell you shares for a bargain. But here's the thing. He doesn't know the value of your business. He just reacts. Your job is to ignore his emotions and focus on your own logic. Think of the 2020 COVID crash. Markets tanked, investors panicked, and the world seemed to stop. But those who stayed, invested, or even bought during the dip were rewarded handsomely within months. Why? Because they trusted their plan. They didn't let Mr. Market's fear infect their thinking. Graham also warned about speculation. Buying a stock because it's going up? That's speculation. Betting on a trend with no underlying analysis? Speculation. And while it can be thrilling, it's not intelligent investing. In his words, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. That quote is gold. Print it, frame it, live by it. Because every time you're tempted to jump into the latest hype, remember what investing is and what it's not. Finally, The intelligent investor knows that market cycles are inevitable. Booms lead to busts. Optimism leads to corrections. And through it all, your greatest ally is your temperament. Warren Buffett put it perfectly. Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble. It's not about how smart you are. It's about how calm you can stay when the world loses its mind. And staying calm doesn't mean doing nothing. It means doing the right thing, even when it feels hard, especially when it feels hard. So, if you're listening to this during a time of market volatility, take a breath. Go back to your principles. Reread your strategy. Ask yourself, are you acting like an intelligent investor or reacting like Mr. Market? In the next chapter, we'll shift from mindset to method. We'll explore how Graham evaluates stocks, how he distinguishes a bargain from a trap, and how you can apply these timeless techniques in your own portfolio. Let's now dive into the analytical heart of Graham's philosophy. Imagine you're standing at a garage sale. Two items catch your eye: a dusty painting and a brand new smartwatch. You look closely, research their origins, consider how much they might sell for online, and weigh the price you're being asked to pay. That's valuation. And that's exactly what Graham wants every investor to do when considering a stock. To Graham, a stock isn't just a piece of paper or a ticker symbol. It's a piece of a real business. That means if you're going to buy it, you better understand what that business is worth. Otherwise, you're not investing. You're gambling. So how do we determine what a company is really worth? Graham's answer? Intrinsic value. This is the true worth of a business based on its fundamentals, like earnings, assets, dividends, and growth potential. The market price may bounce around, but intrinsic value is what the company is actually worth to a rational buyer. Let's consider an example. Suppose there's a company, call it Midwest Tools. It earns $5 per share in profits, and similar companies trade at 15 times earnings. That implies an intrinsic value of $75 per share. If the stock is selling for $50, you've found a potential opportunity, buying $1 for 66 cents. But what if the stock is trading at $90? Then it's overpriced, and no matter how exciting the business sounds, the intelligent investor walks away. Graham doesn't rely on just one metric. He considers a range of indicators, like debt levels, profit margins, dividend history, and return on equity. But most importantly, he demands a margin of safety. Even if you estimate intrinsic value correctly, unforeseen risks exist. Buying with a cushion helps protect your investment. Think of it like buying a house. If it's worth $400,000 and someone offers it to you for $300,000, that's a good deal, unless the foundation is cracked. That's why Graham emphasized checking the fundamentals. What's the company's long-term debt? Is it growing earnings steadily? Is it paying dividends consistently? Has it weathered past recessions? Now, margin of safety doesn't guarantee success, but it dramatically reduces the chance of permanent loss. It's not about avoiding risk entirely. It's about pricing it appropriately. This is where Graham's influence on Warren Buffett becomes crystal clear. Buffett took Graham's approach and refined it, famously saying, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett still honors the core idea. Understand the business, pay less than it's worth, and be patient. Let's take a modern real-world example. During the 2008 financial crisis, many solid companies saw their stock prices collapse. Take Johnson & Johnson, a global healthcare firm with decades of consistent earnings. While the market panicked, its fundamentals remained strong. Investors who followed Graham's teachings saw a high-quality business trading well below intrinsic value, bought in, and were rewarded handsomely in the recovery. Graham also discussed qualitative factors. Numbers matter, but so does the quality of leadership, the company's competitive position, and its industry stability. A company might look cheap numerically, but be a value trap if it's losing market share, facing lawsuits, or led by poor management. And finally, Graham taught that no analysis is perfect. That's why the margin of safety is crucial. You can do all the research in the world and still be wrong. The intelligent investor plans for that possibility. This approach takes effort, but it's empowering. It turns investing from a guessing game into a thoughtful process. It's like being an appraiser rather than a gambler. In the next and final chapter, we'll bring everything together. We'll talk about how to build a portfolio the Graham way in today's world, what to buy, how to stay the course, and how to think like an intelligent investor for life. You've walked through the principles of value investing, navigated the psychological hurdles, and learned how to evaluate a business like a true analyst. But now comes the most important part. How do you put it all together? How does one build an intelligent portfolio in today's fast-moving financial world? First, understand that Benjamin Graham never intended his strategies to be one-size-fits-all. Instead, he offered a framework, a toolkit. The way you use those tools depends on who you are. A defensive investor seeking simplicity and safety, or an enterprising investor striving for superior returns through analysis and effort. Let's start with the defensive investor. This portfolio should be built on predictability. That means a balanced mix of quality bonds and stocks. In Graham's original vision, he suggested a 50-50 allocation between the two. But he was flexible. During risky markets, you could adjust to 75% bonds and 25% stocks. Or, in more promising times, tilt the balance the other way. Today, that same philosophy applies. U.S. Treasury bonds or investment-grade corporate bonds can serve as the ballast in your portfolio. Meanwhile, diversified equity holdings, especially index funds like those tracking the S&P 500, offer long-term growth. Think of this as planting a forest. You won't see results tomorrow, but over decades, it grows tall and strong. Next, let's revisit our example of Olivia, the school teacher from Atlanta. Her portfolio might be 70% in a low-cost total U.S. stock market fund, 20% in U.S. bonds, and 10% in international exposure. She rebalances annually and increases contributions over time. There's no flash, no frenzy, just results. On the flip side, the enterprising investor seeks more active opportunities. But Graham is clear. This isn't for the faint of heart or the easily distracted. It requires time, knowledge, emotional stability, and above all, discipline. Let's revisit Jason, the data analyst in Boston. His portfolio might still include a core index fund base, but he sets aside 30% for carefully selected individual stocks. He hunts for undervalued companies with strong balance sheets and solid earnings. He doesn't chase IPOs or meme stocks. He reads annual reports, follows industry trends, and always insists on a margin of safety. Graham's teachings also emphasize diversification. Even if you found 3 companies you love, putting all your money into them invites risk. Intelligent investors spread their capital across industries and sectors, ensuring no single mistake can sink the ship. Now let's talk about rebalancing. Over time, markets move, and your asset allocation can drift. Say stocks have a great year, and now make up 70% of your portfolio instead of 60%. Rebalancing forces you to sell high and buy low, a habit that strengthens discipline and locks in gains. But here's something Graham believed even more strongly than in math or spreadsheets. Character matters more than calculations. The greatest enemy of long-term wealth isn't inflation or taxes. It's poor decision-making. Panic selling, chasing trends, overconfidence. These are the pitfalls that destroy portfolios. Think back to March 2020. The COVID-19 crash wiped trillions from the market in days. Many investors sold at the bottom, driven by fear. But intelligent investors remembered Graham's wisdom. They stayed calm, they saw bargains, and they reaped the rewards of recovery. As Warren Buffett said, echoing his mentor, "Be fearful when others are greedy, and greedy when others are fearful." That's not just a quote. It's a way of life for the intelligent investor. So what does a modern Graham-style portfolio look like in practice? For defensive investors, a mix of low-cost index funds, some bonds, and automatic contributions. No speculation, no timing the market, just a plan, followed with discipline. For enterprising investors, a foundation of passive holdings, plus a satellite portion allocated to carefully chosen individual stocks or special situations, maybe undervalued small caps, REITs, or dividend aristocrats. And both types of investors share one critical trait: they think long-term. Finally, let's end where we began, with Benjamin Graham's most powerful message. The intelligent investor is not just someone who beats the market. It's someone who is resilient, someone who stays rational when the world loses its mind, someone who views investing not as a game, but as a lifelong journey of growth, learning, and discipline. Markets will change. Technology will evolve. New trends will rise and fall. But the principles of intelligent investing, value, patience, safety, and self-control will never go out of style. So whether you're investing your first $1,000 or managing a multi-million-dollar portfolio, remember this: you don't need to be brilliant. You don't need a PhD. You just need a calm mind, a long-term plan, and the courage to stick with it. Because in the end, that's what separates the intelligent investor from the speculative crowd. And so we close the pages of The Intelligent Investor, not with flashy predictions or overnight success formulas, but with grounded, enduring wisdom. Benjamin Graham didn't promise riches. He offered something far more valuable: clarity, restraint, and discipline in a world fueled by noise, speculation, and emotion. But remember, none of this exists in isolation. These lessons are most powerful when they are layered on a solid foundation, an understanding of how the stock market actually works. To understand the basics of the stock market and how the stock market actually works, click on the video popping on the screen.